We have Dean Kim, Head of Global Research Product at William O'Neill and Company, joining in now to take some questions. Dean, good to have you with us here. Thank you very much. I mean, you know, the market is knocking higher, the Bank Nifty especially here, the Banks Index almost at all-time highs, and then flailing a little bit. What's your sense, Dean? You know, the broader markets have got no such problem. I mean, they're still looking pretty good. Will we push through once this debt ceiling, etc., get out of the way to a newer high, or is something changing in the margin? Your thoughts?
Yeah, certainly the debt ceiling is a bit of an issue, but I think at the end of the day, they're going to come to some conclusion and agreement. So I think pretty soon we'll hopefully, I think we'll see some positive reaction from that. In the U.S., the big theme right now is large cap tech. So hardware and software continues to do very well. You saw the NVIDIA report. They had very strong numbers, and more importantly, they're guiding for extremely strong second quarter. So all of the AI-related names like NVIDIA, AMD, Microsoft, Alphabet, and others, they're keeping the broader index fairly elevated. And then, as you said, you know, the market is kind of grappling with, at the moment, what the Fed is going to do in terms of rates. You know, we've noticed that the recent May minutes, half of the team is indicating that they're not sure if they should continue to raise rates. At the backdrop, we're seeing inflation numbers continue to come down, but employment numbers continues to be very thorny. So I think at the end of it, you know, as we near more towards second half, we should see the Fed sort of back off, and we're expecting a better performance in the market in the second half for sure. But we're kind of treading water at the moment. But it's good to see the index sort of holding up above key moving averages. Both S&P and Nasdaq, they're still trading above 50-day moving average. So that's great to see. And but if the index should, you know, break below that level, that's when we'll start to get cautious. But for now, we're keeping the market in confirmed uptrend.
Dean, morning. What about the Indian markets? After a stealth rally in April and the early part of May, the Indian markets have turned a bit sideways, at least at the key, you know, indices level. How do you see the next 1 or 2 months and then the 6-month picture for the Indian markets from here?
Yeah, so, you know, China is a bit of a concern. You know, China has broken below the 200-day moving average, and obviously that's coming from, you know, looks like they have a spate of COVID breakout, as well as the stimulus from the government isn't exactly pervasive throughout the economy. So we're noticing a lot of China-related names, you know, like luxury goods, as well as even like Las Vegas Sands. They're starting to break down. But the rest of Asia, they're still holding up fairly well. So we have India, Japan, and Taiwan. They continue to be in confirmed uptrend, and Hong Kong and South Korea uptrend under pressure, and the rest of Asian markets are in rally attempt. So, you know, we think, you know, if China can kind of get through this little bit of a phase, the second half looks extremely strong. In terms of India, we like the action in India. The index is very, very strong. You know, holding above 21-day moving average. So I think the 21-day moving average is going to act as very strong support. It's only 1% away. And then, you know, should it fall below that, then you have the 100-day rising 100-day moving average that will act as support. So I think India, you know, it looks very constructive. There's no reason to, you know, really get concerned about India. Has been very strong markets, and I don't see any reason, you know, other than softening from perhaps China demand that, you know, would make the index sort of falter. So I would say continue to look out for breakouts in India. There's a lot of ideas, and we will continue to invest there.
All right. Hi, Dean. Good morning. Dean, what do you make of the Fed minutes overnight? You know, it seems we're split down the middle. Some saying that maybe, in fact, you know, you require a couple of more hikes, hopefully not from an equity market perspective. And some in the camp that say, we'll pause now, and then maybe the interpretation is later this year we get some cuts. What are your expectations?
Well, I mean, it's interesting that, this is the first time that I'm kind of seeing there's a split vote within the committee. I think that's coming from, if you look at the CPI or inflation numbers, certainly the core CPI is coming down. The stubborn factor was the shelter related inflation, but that's rolling over pretty quickly. So I think the Fed should take notice of that. The last bit of the hurdle that we need to get over is employment. So, we are starting to see some softening in the economy. And so that's going to translate or, filter through to employment numbers. We have Meta announcing another round of layoffs. So we think the Fed is going to take note of that. I think it's going to be crucial to see what they do in the next meeting decision. But if they, stop raising rates at the next meeting, I think that's going to be taken very positively by the market.
Dean, thank you very much for joining in.